All right, let's get right into it. Today, we are tackling a huge question. Is one of the biggest names in the AI revolution also one of the most overvalued stocks and, well, maybe ever? Let's find out.
And here it is, the bombshell claim at the center of this whole thing. We're diving deep into the argument that a major AI player's stock price might have completely disconnected from financial reality.
All right, so first things first, let's look at the company in question, Palantir, and try to get to the bottom of this absolutely wild price tag.
To really get this, you have to understand what's happening in the market right now. The whole investment game has kind of shifted. The days of valuing a company on a cool story about the future, they're fading. Investors now want to see actual profits today, and that's putting companies with these extreme valuations right under the microscope.
Okay, so to really dig in here, we've got to look at the actual numbers, the ones that are setting off all kinds of alarms for market watchers.
First up, let's talk market cap. At the time of this analysis, Palantir's valuation was, wait for it, a staggering $370 billion. That's a price tag bigger than a lot of very established, blue-chip companies.
And this is where things get truly wild. The stock is trading at 360 times its trailing earnings. Now, to give you some context, a normal, fair value is usually somewhere in the ballpark of 15 to 25. Palantir is at 360. That's, well, it's just a whole different universe.
And hey, maybe you're thinking, what about the future? Well, even if we look ahead at what analysts think it's going to earn, it's still valued at 153 times those future earnings. That's a whole lot of optimism priced right.
But here's the kicker, the context for all of this. This isn't some company that's been printing money for decades. Palantir is actually unprofitable for years and years. It's only just recently started to turn a profit. And that just makes these massive valuation numbers look even crazier.
So, how on earth do we make sense of numbers like these? Well, let's try to get some clarity by pulling a tool from the playbook of a total investing legend.
So, the legendary investor Peter Lynch, he made this metric super famous. It's called the peak ratio. And the idea behind it is actually really simple, but it's super powerful. It asks, is a company's sky-high stock price actually justified by how fast it's expected to grow? And Lynch's rule for this was crystal clear. He said a stock was a pretty good bet if its PEG ratio was under 1. Anything over that, and you're basically paying more for the stock than its growth can really back up. So what's Palantir's PEG ratio? It's 4.2. That's more than 4 times higher than Lynch's benchmark for a solid investment.
What this really tells us, the big takeaway here, is that using this classic time-tested metric, the stock's price has it's gotten way ahead of itself. It's like the price is living in the year 2040, but the earnings are still back here and today. Okay, so this just begs a massive question, right? What kind of absolutely unbelievable heroic growth would Palantir have to pull off to make today's price tag actually make sense? Let's try a little thought experiment. Just imagine for a second that we could jump 25 years into the future. What would Palantir have to look like? What would it have to have achieved for today's stock price to seem, reasonable?
Well, the answer is pretty mind-blowing. To make its current valuation work out, Palantir would need to grow its revenues by 1,500%. That's not a typo. That's a 15-fold increase over the next quarter century.
And you can see here just how huge that challenge really is. I mean, to hit that 15x target, the company would have to grow by about 35% every single year for 25 years straight. That is an incredibly tall order.
And what makes that feat even tougher is this fundamental idea in finance and math called the law of large numbers. It's pretty simple, actually. The bigger you get, the harder it is to keep growing that fast. It's like financial gravity, and it's almost impossible to escape.
Okay, so we've looked at the crazy numbers. We've looked at the almost impossible growth needed. Where does that leave us? What's the final verdict on Palantir's sky-high valuation?
Well, it really feels like we're left with two completely different stories fighting each other. In one corner, you have all the traditional financial tools, the PE ratios, the PEG ratios, and they're all screaming that this stock is dangerously overvalued. But in the other corner, you have a market full of investors who are betting big that the AI revolution is going to change everything, and that maybe those old metrics just don't apply anymore. And that, right there, is the final, multi-billion-dollar question at the heart of this whole thing. Is a stock like Palantir a historic mispricing, a classic bubble just waiting to pop? Or is this the new reality? Is this a sign of a totally new way of valuing companies that are on the bleeding edge of the AI boom? Honestly, the answer to that question could define the next decade of investing.